You know, the world of currency trading, it's this wild place with huge opportunities, but man, the risks are just as massive. So how do the pros navigate these stormy markets and protect their cash? Well, they use this really powerful strategy called hedging, and today we are going to break down exactly how it works. So, what's the biggest headache for any Forex trader? It's got to be volatility. Exchange rates can swing like crazy based on some economic news, a political event, or sometimes just what the market is feeling that day. It is a constant, unpredictable force that can literally wipe you out in minutes. So that begs the question, right? When you know a huge announcement is about to drop and the market is about to go nuts, how do you protect yourself? Do you just bail on your positions and risk missing out on all the potential gains? Nope. There's a much, much smarter way to play it. And that strategy is called hedging. Now, don't think of it as a sword you use to attack the market. It's more like a shield, something you use to defend what you've already got. It is purely a protective move, designed to guard you against things going south. So what is Forex hedging really? At its most basic, it's about opening a new position specifically to offset the risk in a position you already have open. The goal here isn't to make more money. It's all about losing less if the market suddenly turns on you. Think of it as financial damage control. And when it comes to hedging, traders basically have two main tools in their toolbox. The first is super direct. You just make an opposing trade. The second is a bit more flexible and involves something called an options contract. We're going to dig into both. Okay, this slide right here, it lays out the fundamental choice you have to make. On one hand, you've got the perfect hedge. Total, complete protection, but zero chance for profit. On the other, you have the imperfect hedge, which gives you partial protection, but, and this is key, keeps your profit potential on the table. Let's see how they both work. All right, let's start with the first one, the ultimate form of protection, what we call the perfect hedge. This is what you use when you want to totally, 100% neutralize your risk for a little while. And how it works is, believe it or not, pretty simple. If you have a long position, meaning you make money if the price goes up, you just open an equal-sized short position, which makes money if the price goes down. So now, you're betting on the price to go up and down at the same time. And this visual just nails the outcome, doesn't it? While that perfect hedge is on, your risk is zero. But so is your potential profit. They're both at zero. For every single dollar you might make on one side, you lose a dollar on the other. Your position is basically frozen in time, completely safe from whatever the market does. Okay, I know what you're thinking. Bizarre? The source material even calls it that. Why in the world would you ever do a trade where you literally can't make a dime? It seems completely backward, but there is a very, very specific reason a trader would do this. And here's the secret sauce. Let's say a trader has a long-term position that they really believe in, but they know some big, risky economic news is about to drop. Instead of closing out their whole trade, they can just pop on this perfect hedge, ride out that short-term storm, and then take the hedge off once the coast is clear. Okay, so that's the perfect hedge. Let's move on to the other method, the imperfect hedge. This one offers a much more flexible, more nuanced approach, using things called options contracts. The big difference here is that you're not trying to wipe out risk completely. You're just trying to dial it down. It's kind of like buying insurance. You pay a small fee, it's called a premium, to protect yourself against a really bad outcome, but you still get to keep the potential to make a profit if you were right all along. All right, let's make this real. Let's walk through an example. Let's say you've bought the euro against the US dollar. In trader speak, you're long EUR/USD. You're betting that the price is going to go up. So let's imagine the price is sitting right at 1.2575. You're in your position, feeling good, but then you hear some potentially bad economic news for Europe is about to be announced. You start to worry about a sudden price drop. So what's the play here? First, you see the risk. Second, you buy what's called a put option. Now, an option is a really cool tool. It gives you the right, but not the obligation, to sell at a price you agree on beforehand. So you set that strike price just below where the market is now, maybe at 1.2550. And this is where the magic happens. Even if the euro-US dollar price completely tanks, your put option guarantees you can sell at 1.2550. So your maximum loss is now capped at just 25 pips. Those are the tiny units of price change. Plus, of course, the small fee you paid for the option itself. You've just built yourself a safety net. And hey, this whole thing works in reverse too. Let's say this time you're short the British pound against the US dollar. You're betting the price is going to fall, but you're getting nervous about a surprise vote in Parliament that could send the pound soaring. So in this scenario, your move is to buy a call option. Again, this gives you the right, but not the obligation, to buy the currency pair at a set price, let's say 1.4275. If the price skyrockets past that, you're covered. You can use your option to buy at that lower price, and just like that, you've put a cap on your potential loss. So, all of this, it really boils down to a fundamental choice, a classic dilemma that every single trader faces. It's always this trade-off between protecting what you have and reaching for what you could gain. Which, of course, brings us to the million-dollar question, right? Can you actually make money from hedging? Is it some secret profit-generating strategy? And the answer, according to our source material, is a pretty straightforward no. Hedging is not designed to be profitable. The best way to think about it is exactly like car insurance. You pay that premium every month, not because you expect to get a check, but to protect yourself from a total disaster. Hedging is an expense. It's the cost of doing business safely. This little table here really puts it all in black and white. If you hedge, you pay a little bit of money to avoid a catastrophic loss. If you don't hedge, you keep your full profit potential, sure, but you're also riding a roller coaster with no safety bar. You're exposed to unlimited risk. Every single trader has to decide where they're comfortable on that spectrum. And that really leaves us with a final thought that goes way beyond just Forex trading, doesn't it? I mean, whether we're talking about stocks, starting a business, or just life, we all face this exact choice. So the question I want to leave you with is this. In your own financial world, when is that guarantee against loss actually worth more than the chance for a bigger profit?